How does a beginner buy and understand commercial property without getting burned? Hi, I'm Jared Krause. I am the co-host of the Property Powell Australia podcast, and in this episode, we're chatting with Jake Lambert. Myself and Sam are chatting with Jake. He's a friend of ours. He's also an expert property valuer in the commercial property space on the Gold Coast. He knows so much. He's a wealth of knowledge. His dad is a senior advisor at the company he works for, and he is getting into commercial himself. And we're chatting everything commercial today on how to choose the right commercial property for your first property investment in commercial and what the process actually looks like. Then Jake breaks down the three main risks within commercial property investing, which is cash flow risk, asset risk, and market risk, and what those actually look like and how we should understand those as well. Then we dive into talking about how your commercial property could either lose or gain value based on the market softening and or tightening in your area, or for your asset type, and what that could look like with a few different examples. We break out the calculator here as well. Jake also shares a bunch of value adds and examples you can make to increase the value of your commercial property. And then we also discuss why property values are pretty conservative, but the best knowledge base for how much a property is actually worth in the eyes of banks and investors. And lastly, we discuss the WALE, weighted average lease term, which is within commercial property for multi-tenanted properties, and what that is and why you need to know that for that asset class as well. Now, this is such a valuable podcast. It's not the only way that we can help you for free. If you are looking to buy a commercial property, make sure you have the maximum amount of borrowing capacity that you can get. We actually have a free mini course on how to increase your borrowing capacity. You can get that at propertypals.au/resources. Check that out. Now let's dive into the pod. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Firstly, Jake, welcome back to the podcast. It's good to have you here again.
Good to be back.
Oh, we're recording already. Well done.
Yeah, we're recording. And so just for everybody listening, Jake is at Sam's office now at the moment. And we shared a bit about your background and story and how you guys met and became buddies, and our surf trip and all that fun stuff. So now I guess we'll just dive into the juicy value of commercial property.
Yeah, we're hoping to get a lot of value out of you, Jake.
Yeah, nice.
Yeah, invite you around and just squeeze the value out of you. No, I'm fascinated around how does one go from residential property in their portfolio to commercial, and then when's the right stage. And then also I want to learn so much around how do I go from starting out in commercial, maybe a $1 to $3 million deal, and then building a larger, portfolio of commercial deals. So the first thing that I wanted to chat to you about is like understanding risks of different assets in the different size ranges within commercial property. So for somebody starting out, they're going to buy something between the $1 to $3 million range. And then they're probably going to move like 3 to 10 million and then 10 million plus. When somebody's starting out in that $1 to $3 million range, what sort of assets would you say have the least amount of risk for a beginner? And if so, how and why?
Yeah, look, I think it's pretty market specific. Like it would differ, I guess, location to location, but look, I think every asset has its own sort of individual risk profile, which, the kind of main categories as a valuer that we sort of try and analyze risk through is like cash flow specific risks, asset specific risks, and then kind of market specific and management risks. And you can kind of look at all different asset classes and types through that same sort of risk profile. I guess in terms of, sort of more of an entry level commercial investment, you're probably going to have a single tenant property, you might have maybe if you had a sort of smaller multi-tenanted industrial building, you might have a few tenants, which complicates things a little bit more. But I guess probably something to go through, just say a typical single tenant industrial property, or it could be really any asset class. That might be a good kind of example to go through. So it's your question around like, what are some of the risks you need to be aware of?
Yeah, the question is like, what for a beginner? What should we, what's the first sort of property that we should be buying? I mean, it could be asset type, but then how do you I know for residential, it's typically get your borrowing capacity, and then work out like what you can buy, what type of asset that you want to purchase in your portfolio, and then go away and then look at the market conditions and find that asset in the correct market conditions. So how do you go, like with commercial, say I work out, okay, cool, I can get finance for a $1.5 million deal, know what my deposit is. Do you then go market conditions first or asset type first? In my head, I'm thinking asset type first and then market conditions and then cash flow after that. Like what's, was it?
I understand what you mean now. So I think, look, generally speaking, investors should be driven by yield or level of return. Mm-hmm. And generally there's a relationship between risk and return. So for an asset that might be, have a perception of being more risky, you would expect a higher return. So I guess it kind of depends, initially on your own, appetite for risk. If you're someone who's like, for instance, as an example on the Gold Coast, the industrial market is probably less risky than the, retail and office markets. But at the same time, the yields are firmer. So you're going to get a smaller return for your investment in that space. So if you've got maybe a slightly more higher risk appetite, you might actually get a better return buying a entry-level retail or office property. But again, they sort of come with their own inherent risks, if that makes sense. So I think the sort of driving factor should be really return, and that cuts across all markets. And that's probably a good place to start.
Yeah, I'd chime in as the buyer's agent as well. I'd be like, well, what are your goals, right? And then what's your appetite for risk? It's two key elements. And then figuring out, all right, well, if your goal is to retire in, say, 10 years and you require 100 grand passive, all right, well, what does that actually look like and what do those assets look like? And then if you've got $1.5 million budget, I'd be sitting there going, all right, well, based on that, this is sort of like your return on investment for your cash flow. And then you're looking at, well, what risk are you willing to take? Like, you can go on to say the office market, but your yields might be stronger than the commercial, the industrial. Then on that sense, then you're like, well, where's your appetite for risk on that front? Because your income is going to be greater, but that's what Jake was referring to, right? Like reflected in the risk, in the yield. And there's people that are more aggressive than obviously yourself. You're younger as well, so understanding all those key elements would help get down to that. All right, well, based on what you're telling me, we're looking at this type of commercial property, and then we go into, well, we can't print that perfect property, right? So we've got to go and hunt it down, and that's where you start looking at, all right, if we are more comfortable in the industrial market, obviously if it's your first purchase, we're probably looking at a lesser risk from that point of view. So that means less income generally. And then seeing, well, based on that, what can we find? And then going further through into it is just that it's a constant education process, right? Because like you could find a single tenancy, like $1.5 million, you could find I'd be looking personally for a freestanding property where you, like, the reason why I look at that is that you can manufacture equity by building out more net lettable area on that site. It's just that, what is $1.5 million bucks?
Exactly. And I think that's an important point. It's like you're going to be somewhat restricted by your budget. Like on the Gold Coast, you're not going to get a freestanding industrial building for $1.5 million. The entry.
Come on.
Not anymore.
It's not 1990s.
So you're going to sort of need minimum $2 million really to get into a small freestanding industrial building. But you'd definitely be able to buy a strata unit, or you could look outside of the Gold Coast market. I've been doing a fair bit of research in the Northern Growth Corridor, places in Logan and Beenleigh, and you can definitely get freehold industrial for small properties, but for around $1 million. So it's kind of it's relative to the asset class and the location, and your budget's definitely an important piece.
Yeah, I think what you mentioned as well, Sam, is like for your first property, you want to probably take less risk, which definitely, like, even if you're, say, like you said, young, whatever you classify as young, I believe that for me, and risk is a personal preference, really. But for me, I would be like, let's take less risk and take less money up front, like less ROI up front, to at least learn about the process, because it seems like what everybody says is there's a big gap of knowledge between understanding how to buy a residential property and then knowing what it's like to buy a commercial property and also own it as well. And so
I'll say it's like riding a bike, right? Like you start with the we're dads now, so we can talk about this. But you got the push bike they start on, and then they might get onto the little pedally bike that they sit down on, and then they go into the training wheels on the bike, and then you take the training wheels off, right? Like there's multi-stage processes, and this is the issue that I'm finding in the industry, right? Is people listening to like podcasts like this, they're reading a few books, and they're getting that. What's that effect, Krause? You're probably more over it. It's not the Dunedin. Basically, it's like you learn a little bit and you have this inflated level of confidence. And going through the journey from obviously being in the property industry for so long is like you do feel like you know everything, and then you evolve into a I know nothing period, and then you evolve then into I know a lot, but there's still so much more to learn. And I think that's kind of where we're at, or Jake and I get to a point where like a fair bit. I think the biggest lack in my head was like I didn't really understand how much I knew because I was constantly learning, and then I still am constantly learning. And my fear for people is that they do learn these few things and then they're going out and doing it themselves. And no doubt, Jake, you shared a few experiences last time he was on the pod with just small mistakes can cost you $80,000, and that's something that we're trying to get across in just talking to the right people and getting educated further, and leveraging people's experience to make those better financial decisions.
Absolutely, guys. That's like what Jake shared in that last episode 38, about saving $80K. When you're valuing a property, it's a really good story to go back and listen to if you haven't listened to that one yet. Which, I mean, it segues us into our next part of the conversation, is asking you, Jake, around those different types of risks, right? Obviously, understand what your risk tolerance is, look for ROI, know your budget, look for ROI, and then you can look for asset type, and then you can go then to the location. So say we found all of that, right? We've got our budget, asset type, location, we know what our risk tolerance is. Then you mentioned you've got a few different things in how you sort of assess risk for each individual property. I think it was cash flow, market, and the asset. Was it those three? Is that right?
Yeah, they're the sort of main ones. But yeah.
And so, which one do you assess first, and what goes in order, and then maybe we assess some of those. Say for like a $1.5 million commercial property in a warehouse. I mean, I'm sure that some of them are relevant to other
100%.
Assets as well.
Yeah, they sort of. I think it cuts across all asset types, so it's a good one to get into. And I think so like looking at some of the cash flow risks, and I think this is like fundamentally where there is sort of a fair bit of difference between a commercial property and a residential property. Your tenant is a business, and so you need to know the health of the business. Are they a good quality tenant? So some of the things to look at as an investor, first of all, would be the quality of the tenant. So are they a local business, and there's nothing wrong with that. How long have they been established? Some of these small local businesses might be really solid. They might have been in this particular premises for 10 plus years on multiple leases, and they've never missed a rental payment. So just getting some background on the business, how established they are. Obviously, all these things will impact the sort of yield that the market's willing to pay, but there's a big difference between sort of a local tenant profile and something like a national tenant, where you might have a lease to the kind of head corporate entity, and generally that's a better quality lease. And then obviously the income security that comes with a national tenant like that is generally higher. So quality of tenant, really important to understand. And then I guess just specifics about the actual lease itself. So how long is the lease term? You're better off having a lease might have 2 years left to run, and another lease might have 5 years left to run. So the term certain, the longer the lease is, the longer your income security, which is a really, really important factor. Does the lease have options? So an option is, you might have a 5-year lease with 2 5-year options, and that means that tenant, at the end of their lease, they can sign on for another 5 years and another 5 years. So it's quite important to have these sort of stacked options, and it just improves the quality of the lease covenant.
Can I just chime in on that bit?
Yeah.
The options, it's important for people to know is that the tenants don't have to exercise that option, right? But they have the
right.
They've got the right.
Yeah.
So you as the owner of the property, you come up to the end of the 5-year period. If you don't like the tenant, you've got 2 5-year options onto it, then it's not your discretion to say no, I'm not reletting it to you. And the lease covenant too would have the lease agreement would have the increases. And can you just talk a little bit about, like, at the end of that period, do they go to a market rent? Do they? What's the situation on that front?
Yeah, so this is one of the, I guess, key benefits, I think, of differences between a commercial and a residential investment property. So with a commercial property, built into the lease will be an annual review. So this means that the rent that you're getting will increase by the review pattern set out by the lease. So typical kind of review patterns would be CPI. So every year of the lease, your rent increases by the CPI amount, or you could have fixed increases, like say 3 or 4% fixed annual increase for the length of the lease. So you are getting this increase actually in your rent as the lease progresses. When the lease term finishes at every option, so if you've got a 5-year lease that's finished, the tenant said, yep, we want to take up our next 5-year option. Generally speaking, a lease will have a market review. So essentially, this is where generally this is just done between the landlord or property manager and the tenant directly. But essentially, this is a chance to generally speaking, increase the rent to what the market level would be. So it kind of gets reset. The rent gets reset at this point in time. So there's sort of those protections built into your sort of income security and cash flow.
A point I want to lay out too is that commercial is great, income is fantastic. There are costs involved as well. So to get a lease to market, like Jake, you do a valuation, right?
Yeah. So generally, as I said, a property manager, if you're having a property professionally managed, they generally know what's sort of market rent is, and the tenant generally will accept the managing agents. This is market. This is what your new rent's going to be. There is like a little bit of negotiation that normally goes on. But as an example, at the moment, we've had industrial rents skyrocket over the last 2 years. So there's a lot of tenants coming off leases, and their market reviews might represent could be even up to like a 50% increase in their rental amount. And we're seeing a lot of basically tenants contesting the increases. And then what can happen is if the landlord and tenant can't agree between themselves, a valuer has to come in essentially as a objective third person and do what's called a formal market rent review. And we do a valuation report and assess the rent. And essentially this is what it is. There's no argument there. But that, as Sam said, that can be a costly exercise.
So that only happens when an option decides to get exercised. So that can't happen mid-lease, can it?
Look, it is very rare that there would be a market review kind of during a term. It's not like, it does happen, but that would be very rare. Generally, a market review is at an option, or if if there are no options remaining and a a new lease is being signed, and that would be another chance to sort of reset the rent.
Yeah, so that's a metric that you would be look for the cash flow, like risk, when you're looking at purchasing this property. You'd be looking at the supply and demand in that area as well,
100%.
right? So that you know that like in 5 years' time, there's still going to be enough infrastructure and things happening in this area to ensure that my rent is going to increase for the property you purchase.
Yeah,
That's actually some really good points.
Really
like the valuation risk alerts. I was asked this on a podcast recently, and the commercial side of it.
Give them a shout out, Powell. Who was it? Who was their podcast?
I was property investors. Joe and Jeff.
Yeah,
good men that have a really great community. Yeah, and look, obviously, my mind, I've been a few years out of the valuation industry, but I mean, risk is a massive thing, and that's like, as a valuer's background, like people always tout us to be conservative, and it's like, well, yeah, sure, but who do you want on your team? Is someone who's a bit more conservative with your money, or someone who's a bit more of a spendthrift? And like, real estate agents are paid to get the highest price possible.
Yeah,
valuers are their more risk assessors, in my opinion, because the banks are essentially like they want protection over their assets. So we sort of have these restrictions on using settled sales and settled evidence to justify our opinion. And we do so because the industry has been around for such a long time. Like, buyer's agents have only been around for 20 odd years, right? Like, but the valuation industry and the profession, they kind of stick to themselves because I guess there's a massive skill set that's there. However, they've been through multiple cycles, or they've been trained by these senior valuers, or the directors that have been around in the companies for 40 plus years. A lot of valuers do come in as assistants and stay through till retirement, because it is a nice job.
Yeah, I think fundamentally the main thing to note is, like, as valuers, we are liable to the bank. So like if a deal goes sour, the banks,
someone defaults.
Yeah, it's like, and a valuer's been seen to be negligent, then the banks can sue valuation firms, and this does happen because we have PI insurance. Whereas an agent really they don't carry a whole lot of liability like that. They can be extremely optimistic when they're prospecting and pump up the tires of an owner to try and win business.
Yeah.
But ultimately, we are the ones that we're the eyes and ears of the bank, and if something goes sour, we can be sued. So we do have to we sort of go carry ourselves a little bit differently.
And I think it's the best way to go when you're investing. Really, is being conservative. And I think we should sort of mention this as well. Like, with buyers agents, like, they can go away and like value a property based on like them wanting to sell you that property and get you off the books, versus like what you've done, Sam, is like you've gone in and coached some pretty large buyers agent firms how to value properties. Because there's so many, like, that's the scary thing about so many buyers agents in the last 20 years is like, they can just come out and sell people buy properties for people, but they don't have like the formal education that you guys have from senior valuers that have been through those market cycles, that can be conservative. And that's, when you're choosing a buyer's agent, obviously you want to know how much skill set they have.
Yeah. But yes, my mind keeps coming back to the risk alerts. What, like, for people that are listening, I think it's a key thing I want to focus on today is like, what are those big risks that you're flagging on your valuation report?
I think,
so you've been through Cashflow. Is there any more? I think
maybe just to tie a bow on Cashflow, I think you alluded to something that I think is important, maybe just to double click on quickly, is really understanding the leasing market and the vacancy rates in a particular market, as they can have the potential to influence your rental, the rental rates that you can get for an asset. So, as an example, I sort of mentioned that the industrial rents have gone up a lot in the last 2 years, and this is, a function of very limited new supply.
Logistics boom.
Yeah, logistics boom. A lot of people are carrying a lot more stock, and we've had so many kind of small businesses and just businesses in general move to the Gold Coast. So we've had this massive gap between supply and demand, and that's pushed up rents. Very, very limited kind of very small vacancy factor. So that kind of environment does prop up rents, increases rents. But then if you've got a situation where you've got a really high vacancy factor, probably the best example would be the office and in some cases retail markets during COVID. That places a lot of downward pressure on rental rates because obviously there's a lot more vacancy and huge amount of supply relative to that underlying demand. So that all plays into I guess looking at that sort of cash flow risk, and the potential of, I think really as an investor, that's a really good potential value add opportunity. You might buy something that's under rented, knowing that, okay, this lease is going to be up in 2 years and I'm going to be able to increase the rent by 50%. And suddenly my 5% yield is now 6% plus. So to me, that's a really, really good value add opportunity.
I love that. Feel free to bring and drop more of those value add opportunities throughout the podcast episode, Jake.
You don't know what you don't know. And that's,
it's something to look at 100%. And by the same token, like it can also cap prospects for short term value growth. Like I did a pre-purchase valuation for a investor looking at buying a industrial unit in Arundel, and you have this situation with some of these properties where you've got massively high rents, like historically about as high as they've been, and really, really firm yields, so strong returns. So you've got this situation where I don't see a whole lot of upside for some of these properties. It's unlikely that you're going to be able to get rental growth. Yields are already very, very low. So, it's not to say it's a bad property. Again, industrial on the Gold Coast is really strong, but in terms of short to medium term upside, there wasn't a whole lot there in that instance.
This is actually a question that pops in my head is, we've seen yields compress, right? They've gone from, like on the Gold Coast, like what were they 5 years ago? Like 8%?
Yeah, again, totally asset dependent. But it's funny talking to Dad, like he remembers, 9% yields, and it was, couldn't believe that we were down, sub 5% for some really.
I love where you're going. I love where you're going with this question, Sam, because I think because we've talked about this a little bit. So I'd love to hear Jake's point of view on it as well.
Yeah. What's the commentary in the office? Obviously, each month you guys get together and do your little feel in the market. And this is really great about the valuation industry, is that it's a combined mind approach where you get that feel from each different sector. Is there commentary around yields reverting back to that higher, say 7, 8, 9, or is this the new normal that is being expected?
Yeah, look, I don't know. I can't really make a call whether they'll go back to
future
historical highs. But like obviously with borrowing money is much more costly at present. So that just has a function of flowing through to generally softening yields. Just because investors, if it's going to cost you 6% to borrow money, you want more than 6% return, or else you're not covering even the interest on the purchase. I think, we have actually seen yields soften in most investment markets over the last 12 months. But again, it's pretty asset specific. Again, the industrial space on the Gold Coast is really, really strong still. Lots of sales in that sub 6%. But in some of the, bigger retail assets, we've definitely seen softening of maybe 0.5% to 1%.
Oh, wow.
Yeah.
Because that's really important for people to understand. Like we talk about yields because that's the true reflection of value, right? Like you capitalize out that yield. But if you buy an asset that's on a 6% yield and that increases to a 7% yield, that's dramatically affecting the value of your property.
Yeah,
right?
like unless you've had rental growth to offset that, the value of your property has gone down fundamentally. Yeah, all things being equal.
I would love to get an explanation of that, because we were talking about that as well, Sam. But I'd love to hear that from you, Jacobs. Like, let's just use round figures, right? $1 million property, and it's just at 6% yield, and then it goes to, so you buy it for $1 million, and then it goes from 6% to a 7% yield. how does that affect the valuation of the property and the cash flow?
Before we continue today's pod, I want to ask you a few questions. What is your property investment goal? What type of properties do you want to own? How many? What size valuation property portfolio do you want to own? And how much net income do you want to be earning? Essentially, what's your magic number in passive income that you want to be earning? And do you know how to get there? And if you do you know how to get there in the least time possible with the least amount of risk? Sam and I have been helping people invest in property and build property portfolios for years. People who are now replacing their income through property, and we want to help you do the same. Right now, for a limited time, we are offering free property coaching to our listeners. We won't be able to do this forever, of course, so head to propertypowers.au/coaching. That's propertypowers.au/coaching to see how we can help you achieve your investment property goals. Link will be in the description too.
Isn't that great?
I'll have to get a calculator out.
Yeah, my maths isn't great. That great off the top of my head, to be honest.
Mine is terrible as well. I've always got my phone with me here.
Yeah.
Well, you got your phone with you. Do the math, right? So, all right. If you've got income of 60, like you've got $1 million property. This is a good exercise. You've bought it. It's generating $60,000 in income. Fantastic. Yep. That's a 6% yield you've got going on that property. What you do is you capitalize that out. So if it goes up to a 7% yield, then
it's 70 grand.
It's nearly 150k.
Yeah, 800.
So like you said, it's nearly 150k. How did you get to the 150k? So you've got $1 million property. It's making 60 grand, and it goes to 7% yield. Yeah, you bought it for $1 million.
You bought it on if you got 60k, you bought it on a 6% yield, so divided by 6%.
So you bought a property for $1 million, and it's making 60 grand, and then goes up to a 7% yield.
Yep. The easiest way to do that is just 60,000 divided by 0.07, 7%. Gives you 857k. So it's eroded $150,000 worth of value by that yield softening by 1%, just as a function of the return, if that makes sense.
Yeah, that's huge. It's a huge thing to understand, because people might think it the other way. It's like, if I go from like a 6% to a 7%, that's good.
No, well, that's 7 to a 6.
Like it's firmer yield is
It's a bit of a minefield to get your head around.
Opposite to what you think, but
we'll unpack that, because that's where a lot of people are at. Is like, it's gone from 6 to 7%. But it's the property price has gone from $1 million to 850. So that's the negative. But what's the positive then?
So to get to your value, you're dividing your income by the market yield for that asset type. So if you've got, and so that's what Jake's doing, is he's gathering evidence. Actually, you're the valuer in commercial. You talk about it.
Yeah. So essentially, that's where market evidence comes into play. So when I said last week, I realized when the pod finished up, I probably used some technical language and didn't explain myself very well. But that's why we look. Essentially, this is a valuer's job. Is we need to be in touch with what's happening in the marketplace, and how we do that is we stay on top of recent sales. So if I'm valuing a leased industrial unit, I'm looking at, what other leased industrial units have sold, and what sorts of returns have the sale prices reflected based on the income of those properties. And you can get a feel for where, the market yield range is, just based on looking at the sales evidence. So we're not just making a judgment. Like, I can talk about, hey, yields have softened sort of, 0.5% to 1%, but really that's driven by our analysis of comparable sales evidence, and that's what we're doing as part of the valuation process. So as kind of a market softens that trend line, speaking generally, you're going to see yields fill out, which if you haven't had rental growth, that is going to impact the value of your property and how much equity you've got sitting in it. And the flip side is also very true. If market conditions improve and yields tighten, suddenly your $1 million property might be worth 1.15, and then suddenly you've unlocked some equity, which might help you go again for another purchase. So that's one factor. But obviously the rental side of thing is also another dynamic. So if you can grow the rental, even if the yields stay the same, you're going to see an increase in the property value. if that makes sense.
Yeah. So as the yields tighten, you add more value to your property, which can help you scale your portfolio, which is what we're all about here, right? Like, you don't want to buy something that's at 5% and it goes to 6% or to a 7% because it softens, like you said, words, using language in the space, and then you've got tightening. So, cool. That's good to know, because ideally you would want buy something at 7% yield and it goes down to like a 5% yield, and you're going to get growth from your property.
100%. And there's lots of things you can do to improve that kind of, again, this is sort of that relationship between the risk and the return. So all those aspects I spoke about earlier, about quality of tenant, length of lease, all those income security pieces, they all have an influence on, generally speaking, on the yield. So if I have two identical properties, one of them both leased to local businesses, one has 5 years left to run on a lease and one has 1 year left to run on a lease, the property with the new 5-year lease is superior and should show a firmer yield and a higher value. So that just speaks to you can improve the kind of positioning of your property that you own by securing a better quality tenant, getting them on a longer lease, all those factors I've already spoken
Another
about.
golden nugget from you, Jakey, on value add, because that is a value add that people wouldn't think about. When you're coming from residential, people think, okay, value add, how do I renovate the property, or how do I do something to the property to add more floor space and stuff, which is a value add, of course. But one value add that is like I would say not a hard value add to grab at, and it's not going to cost you much money other than maybe another valuation, right? Is buy something with a lease that's going to end soon, but knowing that you've done your DD on the market conditions.
Yep.
Yeah. You even could put in due diligence clauses into your offer, right? And then you can have those good, hard, long conversations with the tenant before signing that contract or settling on that property to see what their intentions are.
Yeah, because the banks also, the only problem with that particular value add that I see, and again, I'm in the process of, trying to buy my first commercial property myself, so I don't have a whole lot of experience on the financing piece yet, but, I assume that if you're trying to get a lease doc loan or something like that, if your property's got poor income security, like quite a short lease, that's going to impact how much you can borrow. So whilst it's probably a value add, it might impact your ability to finance. Does that make sense?
Oh, that's a good caveat when going for a lease doc loan and ability to finance. I like that.
Or depends on. So if you this is the issue with a lot of like the commercial on the negotiation side and the buy side is you'll get a better lease doc loan from that if you can get the tenant to sign a lease agreement prior to you going to contract on it. The issue is that from a buyer's perspective, as soon as you do that or you introduce that to the seller and the seller's agent, they know that's going to increase its value.
Exactly.
So that instead of paying 1.1, they're going, oh, well, the tenants agreed. We didn't think they would, so we don't want 1.1 anymore. We want 1.3.
Yeah, the yield should be 5.5%, not 6%. Now that we've improved the income security, so I reckon ideally you've got the funds to kind of do it as is where it is, and then you create that additional value yourself
after the fact. Yeah, because then you're not helping them realize value. You know the value, but just putting a bit more money in to get the deal across the line, and then you realize it later.
Yeah. And there's a pretty good example of this in Mollendina on the Gold Coast, an entry-level freestanding industrial building. It had a tenant in there with I think the lease had less than a year to run, and it was really, really under rented, and it sold very, very cheap. I reckon even like 200 or 300 grand under what they would get if it was rented at a market rent. And they're in the process of renegotiating, doing a market review and getting a new lease prepared. There's a lot of pushback from the tenant, I understand, because their rent's almost, going up by 30% or something like that. But once they secure that and get that all locked in, I assume they're going to have a pretty nice little equity piece sitting in that property, because there would have been some uplift for sure.
That's a good. That's a
tips and tricks
really fun way to think about value adds without having to deal with tradies and like council and stuff.
Yeah. Well, that's the bit about commercial, right? And massive education piece, but a lot of the value is in the income. So if you're figuring out ways to basically just increase your income, you're actually essentially figuring out ways to increase your capital value as well, which is obviously you're getting the best of both worlds on that front. But the income side is what that's your lifestyle piece, right? And there's always this argument: do you go capital growth? Do you go income? Commercial, the education's a lot more readily available these days, but like we're still seeing a lot of people making those big mistakes in the commercial front because it is a massive education piece. And
for sure. I think just sort of last point on the rental side of things is like, there's value add for if something's under rented, but at the same time the kind of flip side is true where if like something I look at as a valuer is, okay, this tenant's paying X amount, is this above market parameters? Are they paying, is their rent really, really high? In which case the actual value of the property is going to be quite inflated. And what happens if there's a market review in a couple of years' time and the rent goes backwards because it was over market, and then that actually will have obviously the inverse effect of a lower property value if the rent drops back. So I think that's a massive thing to look at as an investor is ensuring that the rent the tenant's paying is not above market parameters. And this is it's actually fairly common because if someone knows they're going to take their property to the market, they'll try and get a new lease in place, pump up the rent, and then take it to market. And this is where the old leaseback, the leaseback is
dangerous.
A bit dangerous. So I don't know if you've explained
what
a leaseback is.
Yeah, go for it.
So a leaseback is where you might have a person who owns a property and they've been owner occupying that property for a long time. And before they go to sell it, they basically put in place a lease to themselves and then sell it as a leased investment, and they stay on as a tenant in the property. But often what you'll see is because, there's no negotiation with that, they can kind of set the rent however they want. Quite often with a leaseback, you'll have a situation where the rent is really, really inflated. And, at the end of that lease, if that tenant decides to leave or there's a market review or something like that, there is a potential that your income could go backwards if you can't get that same rental level.
Yeah. And then
so be sus on leasebacks.
Yeah, sus on leaseback. Yeah.
It's not to say that there's not, they're always bad, but you need to look at them with a critical eye.
It's a very tricky line to play when you're going to go buy something based on yield and ROI, I guess, with commercial then, because if you want to go less risk, you have that play of like, I might buy something with like a 4% yield, and it could go the other way where it goes to like a 5 or 6% yield versus like maybe I buy something for like with a 7% yield and go for like a little bit higher yield and then go from 7% down to like 4 or 6 or 5%. It seems like as a beginner, it's a tricky line to play, but you really need to know, I guess, the market. And what I think about this, you mentioned the 3 different types of risk, right? You've got cash flow risk, and then you've got market condition risks, and then you've got asset risks. The way I would visualize this in my mind is like a Venn diagram where you've got those 3 circles that overlap each other, but in the middle you've got that like perfect property. That's the way.
There's definitely interplay. Yeah, no, for sure. Yeah, for sure.
Yeah.
Sorry, I just had to duck out for a second. My mother-in-law just came home with my son and had to let her in.
I was thinking about when you said as a beginner, you're relating investing in property to like being like a child. Now that you've got kids, both of you guys, like, and riding a bike and learning to ride a bike, it can be similar. For me, Sam, I would not be buying a property the way Archie rides a push bike because he is a loose unit.
Well, most people do, mate. Like I've heard stories of people still in 2023 going to auctions without pre-approval, and just bidding at auction and then figuring it out later. So
that was that market. Hey, just so much FOMO and people just taking big gambles. It's that sentiment has shifted like dramatically.
Yeah, when you were talking, I remember a commercial place that I valued back in the day, and it was an industrial warehouse, but they had actually built in like an unapproved mezzanine over the whole floor.
Yeah.
And what it actually did is it detracted the value from the core asset being industrial property, and it was like they had a really high rent, and their expectation was, well, the yields on this is. Or back in those days, back in the old days, they were like 8%, and you're like, oh, well, it should be worth X. Do you want to just talk about it a bit?
Yeah, so that's I think I think this touches on that interplay between your asset and some of your cash flow risks. So yeah, unapproved mezzanine is a big one. I had literally the exact same example. Something that I valued last week was a industrial unit, but they had basically a full floor unapproved mezzanine. So it was a second level that covered the entire ground floor. And basically the whole unit had office fit out. And like, not to get boring with town planning stuff, but you can only have like 20% of your floor area as office in an industrial location. So essentially they had use risk where the office use wasn't approved and the mezzanine was completely unapproved as well. And their expectations were huge because they expected me to just apply full value across all the unapproved accommodation and all the approved stuff underneath it, and apply rent to both those areas. And interestingly, the owner called me and said, mate, this thing's worth $1.5 million. I had a real estate agent come and knock on my door and give me
what do you know, Jack?
Yeah, give me an assessment 2 weeks ago. So your valuation better be in line with what the real estate agent told me. And I went back and like very calmly and just explained, they've just looked at the total area. They haven't cared about whether or not it's approved. And they're prospecting, so they're trying to be super optimistic. And
they just want to get a property sold under their
they want to win your business. So they're gonna talk things up, and then when rubber hits the road and it's actually on the market and they're miles off, it's sort of a bit late at that point.
Yeah,
we've had a good friend of ours. You go, Sam.
Oh, so yeah. Oh no, yeah. That's the biggest issue, right? Is that people have these unrealistic expectations based on someone's obviously it's educated opinion being a real estate agent, but there's a lot of like new real estate agents that are coming into the industry, and they may not have that level of experience. But the over-promising and under-delivering side, you don't stick around much as an agent, and that's a really key part of
choosing an agent.
Yeah, choosing an agent, but also looking at it from your real estate agent. Like the perception of real estate agents in Australia is rubbish, right? Like the trust levels are like 5%, and this is why is because you're getting these people who are commission-only agents. They need to eat, and they're happy to promise you a perceived price. And they train in these scripts and dialogues to get you to sign that in Queensland, the Form 6 to sell the property for you. And then they just lean on the market and they beat you down on your expectations, saying, it's not me. I believe it's this, however, you need to sell, as we mentioned, when you first, you bought elsewhere, whatever the reason is, they start pressuring this, like the seller, who they're actually working for, to sell the property because they don't get paid. They don't get the commission. And that's the difference between a good agent and a rubbish one. But that's what the issue is. The value too is that you're going up against this every single day, and the way that Jake explained it is just you literally are educating these people on the asset that they've owned.
And that was literally the problem. So when this guy bought the unit, he wasn't told about the mezzanine. He just assumed that it was all approved, and he paid a rate per square meter across the total floor area. And he was a cash buyer, so there was no valuer coming behind and just checking the deal off. It sort of all went through without a valuer or someone else casting an eye over it. And he was pretty shocked to find out all this information about the unapproved status. So again, I think it just plays back to the importance of, if you're an investor and a buyer, you need to be doing your due diligence, and it really pays to understand this side of things.
I've got a question. as I always do. Sorry, Jared. I love talking to Jake. We just push preams around and drink coffee.
You guys don't even need me. You don't need me here. You guys can just have a
you
chat.
ask great questions.
You're the host. I'm just the.
I'm just a beginner learning, and you guys are the gurus. And it's like, help me win at life.
Yeah. Well, we're not life coaches. That's your domain these days, mate.
Help me invest my money.
Just walk me through. So with that, the unapproved mezzanine is massive. Do you actually take into a rate of removing that, like in your valuation? Like, how do you?
Yeah,
how do you value it?
we don't. I don't take into account removing it. Essentially, and this is, I guess, another important piece to know as an investor is banks, generally speaking, they don't want to lend on accommodation that is unapproved. So essentially, whilst it may have value to the market, while you may be able to charge rent for some space that's unapproved, if you own the unit, when it comes time to getting, refinancing, trying to draw on equity, a bank, from a valuation perspective, we can't adopt any value directly for that unapproved accommodation, whether it's rental value or capital value. So you don't
because
make sure that you have
risk relies on the bank, right? Like if for example, the person can't repay the loan and they have to sell the property, but the value of the property is not all the total value of what they perceive as property approved, the bank will lose that. So that's why the bank.
It's not even that. Sorry, I should have said, like, there is the risk that council comes along and says, hey, that mezzanine's not approved.
Yeah.
Pull it out. So that's where the risk lies. Like, it's unlikely that happens, but you can never be too sure from the bank's perspective. They just don't want to borrow it. How we deal with it, generally speaking, I might apply, if it's really good quality and it's got good utility, I might just apply structural value to it. So it might be, a few $100, $500 a square meter, just to acknowledge, hey, it's a structure that has some value. But look, ordinarily, and there's lots of, I've seen a fair few examples of this where industrial units that have lots of unapproved mezzanine that wouldn't really appeal to a normal industrial user because there's not much warehouse, it's got lots of office, lots of mezzanine. Yeah, those units will actually be discounted sometimes when they go to the market, just because you've got less people that want them. They don't appeal to a broad selection of industrial users. So that's another thing to be cautious of. If you're buying a property with lots of specialized fit out that's not going to suit everyone, that could impact your ability to lease the property and sell it if you wanted to sell it. So yeah, that's kind of a big and that's another asset risk piece that we look at is, if something had really specialized fit out that wouldn't suit everyone, or just a weird property that didn't suit everyone, we'd flag that as a negative risk.
And I guess that's like when you we talk about this and with residential property, when you're going to do a renovation, don't do a renovation based on like, oh, I like the walls pink, and then the rest of your market like, like we're going to devalue that because you're not optimizing or renovating your property for what the market actually wants, to who you're actually going to sell to.
Yeah, 100%. And I think this is one of the big shocks to a lot of, like, it's mainly owner occupiers where they might buy a property and then they spend, like some stupid amount of money doing high quality fit out or really, really specialized fit out. And then they expect, the market to come along and go, well, you paid $1 million, you spent $500,000 on fit out. The value of the property is 1.5, but generally speaking, cost of fit out doesn't equal value or end value in the marketplace. So you've got to be a little bit careful there.
Be smart about it. Ask the right people the right questions.
Tell me, what about these approvals from council? Are they hard to get, and are they costly as well, like for mezzanines and changes to properties like this?
Yeah, so look, I'm not a town planner, but we do have to cover it off in what we do. So generally speaking, there's a couple of different types of approvals. You've got a material change of use approval, but essentially that is a full approval where if you had, say, a mezzanine in a unit that you wanted to get approved, council would have to come and look at, do you have enough car parks to account for the additional floor space? So there's like minimum car parking ratios that you have to meet. And look, ordinarily, you got a fat chance of getting any additional floor space in. When that complex was originally developed, they maximized the amount of floor space relative to the car parks. And this is really sneaky. So you can actually get a building approval, which is different to a full MCU approval. And that can be done by just a private certifier. And essentially it doesn't go through council. They come out and what they do is they certify the actual structure. But all you have then is a certificate that certifies the structure. It's actually not technically approved by council, but a lot of people will sell units and claim that something's approved, and agents generally, it's not in their interest to distinguish between those two types of approvals. And they'll just tell you that it's approved. They'll even show you the certificate. But that's really where I see people getting burned, especially for industrial units. Like that's really one of the main asset risks, in my opinion.
Just reiterating that, everyone listening going, oh, that's really cool. Basically, a building approval is not a council approval. So when you're buying these assets, look for the council approval every single time.
Yeah, it's a private certifying approval is not a full approval from council. Yeah,
and insurance too. From that aspect too. If you have an unapproved structure, you could have complications with insurance, 100%. Which you might not even know. Right? You could be paying your insurance policy for the year, go to claim on it, and at that stage you get a really hard slap in the face by education around it's not approved, so we're not paying out. And then,
so the insurance thing, is that like you might, if you have a building insurance or building approval, doesn't mean, so for insurance you actually need the council approval for insurance to come into play?
Yeah, good question. So the building approval will most likely give you that sort of insurance, I guess,
ability to claim.
Ability to claim if it's being built correctly. It depends on what the case is, right?
Yeah, true.
But if you have like an unapproved, insurance policies is what I'm sort of like speaking with a lot of caution, is that insurance policies are constantly changing their policy. Insurance companies are constantly changing their policies. So like for me, from a risk perspective, I just wouldn't take it on. I don't care if you've got a building approval. I'd always be seeking council approval because the insurer, depends on who you're using. It's not hard for them to turn around and say, yeah, you've got your building approval, but you don't have council approval, therefore we're not paying out, because like 9 times out of 10 insurance companies are going to find a way to not pay you out.
I think like from what I've seen, it's probably less important if you've got a strata unit, because the insurance is through the body corporate. And mezzanine's not, I don't want to just bag it out. Like unapproved mezzanine can actually be good if you're an investor, because you could charge your tenant rent for it, but you don't want to pay full. Like if you're buying the property, you don't want to pay full value for the unapproved accommodation. So in a way it is good and actually can be a value add, but you just don't want to be paying full price for it. But I think, there's a guy that we do a lot of work for, this 60-year-old bloke who owns about 15 properties in Arundel. He just owns everything, and he's been slowly building his portfolio. He's a super interesting dude, actually. He doesn't own his residential property. He rents, and he's always put all his money into commercial properties, and he's got a pretty nice portfolio. But
can we get him on the pod? The mayor of Arundel?
Yeah, he's pretty rough, eh? Like, I don't know.
Let's get him on the pod. It'll be hilarious.
More than me.
I know. I could have a chat to him.
Well, that's like the rent vesting space. So I was looking around, and like I can go and rent something like a really nice home for $1,500 a week.
Yeah,
and then go and buy a commercial that's paying me $2,000 a week. I don't have to fix anything on the resi side of things, because I tell the property manager to come fix it. And you're generating a higher cash flow, and that's that. Obviously, go back and listen to the rent vesting strategies that we talked about in the podcast, because especially when you get to those higher priced rentals, when your net wealth is that you get more value for money with the higher rental, because not everyone can afford it, so the demand level isn't as strong. So you can rent a $3 million property for $1,500 a week, whereas if you went and bought that, you'd be costing you $2,000 to $3,000 a week just to hold it in repayments and insurance and rates and everything. So sidetracked on that one. Sorry.
No, I think just to tie it off, and he told me that it can impact these are like freestanding industrial buildings that he owns. If you've got unapproved accommodation, and it can impact your landlord's insurance. So if like your tenant had an issue or something, or someone hurt themselves on it, there is the possibility that you may be liable if there's kind of unapproved areas in the property. So he doesn't typically touch them.
I know we're about to go into the hour, but how long would it take you? The weighted average lease expiry is Wales, something that I think people would get a lot of value out of. Do we have much time for that? Is that a big can of worms?
No, it's not really. It's just an extension of, so we were talking about kind of the cash flow risks and income security, and we were doing that from a single tenant perspective. So when you've got one tenant, if a lease had 4 years to run, we'd call that a lease term certain, would be 4 years, because you know that excluding the options, you know that your tenant's going to be there for 4 more years. A weighted average lease expiry is relevant for a multi-tenanted property, and essentially what it does is it weights the kind of the remaining lease terms of all your different tenants relative to either their proportion of floor area in the complex or their proportion of total income of the complex, and it sort of does this weighted calculation. So, but the whale is that amount in years, and generally, well, not generally, always a higher whale is superior. So it's what you want. So some of these kind of investment grade retail centers and things like that, some of these whales, a whale of like close to 10 years or something like that.
Wow.
That's like primo investment grade kind of lease covenants.
That's like a big old humpback.
Yeah, like you see some of these like medical, leased 10-year leases to medical users, national medical users, or a group of medical users, and that's when you start to see these super pretty firm yields, because they're really secure. The income security is really secure. You've got good quality tenants, long whale, and that's when you're starting to see some of your like institutional investors in some of that space.
What are those asset sizes? Just out of curiosity, are we talking like 50
like 10 mil plus? 10
Sorry,
mil plus. 10 mil plus.
10 plus, yeah.
But look, any multi-tenanted property, obviously has a whale, but yeah, some of those, like, I'm just trying to sort of demonstrate the relationship between the, something that has really, really good income security and the yield that a property like that might show versus something that has, pretty poor income security, like a 1 or 2 year whale. Yeah. Does that explain?
Yeah,
what you
summary. Yeah, good summary. Because that's like it also de-risks it with multi-tenants, because obviously if one vacates, then you don't lose all your income.
Yeah.
So getting your head around that as an investor, I think, is important, and it's something that I definitely look for in deals. It's but then they're
hard to get.
It's just hard.
The entry level kind of less than 1.5 mil freehold and multi-tenanted is like difficult to find. Well, especially on the Gold Coast, it's quite difficult to find. But that's something I'd be looking for sure. Little multi-tenanted industrial building, entry level, like that's what you want.
I like it. Wow, what a combo! I feel privileged to sit with you lads. Thank you. I'll be back in 2 weeks.
Have we mentioned that it's Sam's birthday today as well?
Yeah, happy birthday, Sam.
Podcast?
Yeah, cheers. 35.
35 and working on the pod. There you go.
Yeah, well, it doesn't really feel like work.
It's been great.
Chat to my property enthusiasts. Yeah, I don't know, 35 years young, and I don't know, maybe this podcast will go for 35 years, Krause. We might be that old guy in Arundel with about 1 million commercials.
The dream.
Dude, if we've only got 15 commercials in Arundel in another 35 years, we're doing something wrong.
Yeah, well, it's only one every 2 years, basically.
Yeah.
Should be right.
I don't see why we wouldn't want to continue to chat about property. Like, I think it's a long-term game, and there's always something to learn. So,
it's interesting. I mean, I got to find it interesting. If I didn't find it interesting, my job would be pretty painful.
Yeah.
Learn, do, teach, share, grow, right? So
absolutely.
That's what we're all about. And speaking of which, there's if you are thinking about getting into commercial property, please reach out. Like, there's many questions you'll have, but we can at least point you in the right direction. And even if it is just, like, say, Jake, for example, senior valuer here on the Gold Coast, those pre-purchase property reports that valuers do, really help de-risk it from that point of view. Jake's talking to people every single day about their commercial assets, and it might be like, depends on obviously the asset type. It could range from like fees, like 1,000, 5,000 or something.
Yeah, depending on the price point and the property asset type. But yeah, I mean, I think it's a small price to pay.
Absolutely.
Yeah, I mean, if it goes wrong, it can go pretty wrong. So
yeah. Speaking of which, Jake, how do we get people in touch with you? Should we get people to reach out if they want a val or?
I mean, probably through Sam, or I can give my email address. But yeah, I'm at Herons Hall White on the Gold Coast.
Yeah,
and sort of do all Central Gold Coast commercial vals, plus a couple of specialised areas. I do accommodation, going concern work. That's a whole other can of worms.
Next time, Jake, he's got some really interesting yields. Like on some of those going concern motels you've been doing. You've been talking about them to me.
Yeah, I'm a massive fan. I reckon that's a whole other pod. But yeah, right. I had my head in leasehold motels last week, and like small entry level kind of leasehold motels. There's been a couple sales on the Gold Coast showing about between 25 and 30% returns on, both these were small motels, and they price point were $850K.
Whoa.
Yeah. But that return is assuming that you own and manage it, so that you live on site. So that doesn't include paying for a manager, but
that's active income.
Yeah, but once you get up a little bit higher, like say you're at a $1.2 million price point, there's kind of enough. There's enough in the net income where you could employ a manager and it still showed pretty nice return. But they're more risky. Like, you're buying a business, so you don't own the real estate. You just own the leasehold. But yeah, that's that relationship between risk and return.
Dangle the carrot so people keep listening to us.
Yeah, guys.
I do like that space.
We'll have to get you back on maybe for a Christmas special or something.
No, I'm saying this is fun. I really enjoy it.
Title, Jared, you can imagine it. 25-30% returns. God, we'll have everyone.
Yeah. I've got the clickbait title in my head right now. Nice. All right. Thanks, lads. So much fun chatting to you guys. I'll be back in 2 weeks, so we'll catch up and probably do a pod together. It'd be awesome.
Yeah, back on the Gold Coast.
Yeah.
It'll be good to see you in person.
Yeah, we'll be good. Yeah, nice. 2 weeks.
Yeah, you're international podcaster, you.
Yeah.
All right, guys. Thanks for that. Speak to you soon.
See you, mate.